The Canadian dollar just posted its biggest monthly gain in over a year, and it happened while oil prices hit wartime highs and inflation forecasts climbed. That is not a contradiction. It is the mechanism. Here is the chain. The Iran-US war has tightened the Strait of Hormuz, the choke point through which roughly one-fifth of the world's oil supply flows. Crude in North America has now climbed to near $125 per barrel, up 30 to 40% since the conflict intensified. California gas crossed $6 a gallon this week. Canadian pump prices are on track for $1.90 to $2 per liter. Those are not just consumer pain points. They are the numbers the Bank of Canada is watching with alarm. The bank held its policy rate at 2.25% for the fourth consecutive meeting on Wednesday, but Governor Tiff Macklem's tone was unmistakable. With inflation now forecast to hit roughly 3% in April, driven directly by energy cost pass-through, the bank signaled that any future rate increases would arrive in consecutive steps, not isolated moves. The floor on Canadian rates, which had looked settled, is no longer certain. Markets read that signal immediately. The Loonie strengthened because higher rates attract capital, and because Canada is an oil-producing economy that benefits from elevated crude prices even as it imports inflation from them. That dual dynamic is unusual but not unprecedented. Canada sells oil. It also borrows in a currency that strengthens when oil strengthens. Both forces converge this month. The knock-on for Canadian bank stocks is real. Higher for longer rates expand net interest margins. CIBC reported adjusted diluted earnings per share of $2.76 in fiscal Q1 2026, beating estimates by more than 15%. Bank of Montreal posted adjusted net income of $2.55 billion, with provisions for credit losses falling sharply, from $1.01 billion a year earlier to $746 million. Manulife, as an insurer deploying large fixed-income portfolios, also benefits from a higher yield environment. These are not coincidental results. They reflect what happens when a rate floor firms up under a well-capitalized banking system. The housing market is the wild card. Higher rate expectations crushed home price growth over the past 2 years. Now, the same signal that constrained buyers could reignite demand from buyers rushing to lock in before further hikes. That self-reinforcing dynamic is exactly what Macklem is trying to prevent. While the Bank of Canada was navigating inflation signals, the world's largest energy companies were sending a different kind of signal, with capital. On April 27th, SHEL announced it would acquire ARC Resources, a Calgary-based natural gas producer, in a transaction valued at approximately 22 billion Canadian, including assumed debt. ARC shareholders received $32.80 per share, a 27% premium to the April 24th closing price, paid 75% in SHEL shares and 25% in cash. The deal is expected to close in the second half of 2026. The timing is not coincidental. ARC's Montney formation assets, centered on the Kakwa, Attachie, and Greater Dawson Place, give SHEL access to one of the lowest-cost, most politically stable natural gas reservoirs on the planet, at precisely the moment when global LNG markets are structurally tightened by Middle East disruption. ARC reported average production of 418,522 barrels of oil equivalent per day in Q1 2026, up 16% per share year-over-year, generating $967 million in funds from operations. SHEL is not buying distress, it is paying a premium for optionality. The broader story is Canada repositioning itself as an energy security provider. Canada's Natural Resources Minister Tim Hodgson, speaking at the Sierra Week conference in Houston, framed a partial Keystone XL revival explicitly as a tool for U.S. energy security. The Trump administration confirmed it is working with Canada on permitting for the Bridger pipeline, which would increase Canadian crude exports to the U.S. by more than 12% if completed. Trump also signed the presidential permit authorizing the project this week. The pitch Canada is making is direct. The United States consumes roughly 20 million barrels of oil per day, but produces only 12 to 13 million. Canada supplies approximately 63% of the difference. With Persian Gulf output under structural pressure, that arithmetic has new urgency. Meanwhile, Apollo, Blackstone, and KKR are reported to be competing for a stake in LNG Canada, the export terminal that SHEL already co-owns. Private capital chasing Canadian LNG infrastructure, while SHEL deepens its upstream position, suggests institutional conviction that this trade is not a short-term oil price play. It reflects a structural re-rating of Canadian energy assets under conditions where stable, allied country supply commands a scarcity premium. The complication is the CUSMA trade deal, which comes up for review this summer. Over 85% of Canada's U.S. exports currently enter tariff-free. Any disruption to that access would blunt the investment case significantly. Carney's government has been explicit. The goal is not to reduce sales to the United States, but to add new customers. The Sovereign Wealth Fund announced this week is part of that architecture. The two threads running through this week: an inflation-driven rate inflection, and a structural energy re-rating converge on a single variable, whether the Iran conflict extends or de-escalates. If oil stays near current levels, the Bank of Canada will face a genuine choice between risking entrenched inflation and raising rates into an economy that is not yet firing on all cylinders. That path favors Canadian banks, the Loonie, and energy infrastructure. It also complicates the housing recovery and pressures rate-sensitive sectors. If the conflict eases and oil retreats toward $90 to $95, the pressure on the Bank of Canada dissipates quickly. Rate hike expectations would unwind, the Loonie would give back some of its monthly gains, and the SHEL ARC thesis would shift from urgency to strategic optionality, still valid but repriced. In that scenario, the private equity competition for LNG Canada stakes would likely cool, and the pipeline permitting momentum would slow under less favorable political pressure. The weight of evidence points toward the persistence trade. Macklem's language was deliberate. Shell does not do $22 billion deals for short-cycle events, and Canada's export diversification push has infrastructure timelines measured in years, not quarters. But this only holds if Middle East supply disruption does not find a rapid diplomatic resolution. Two things to check in the next 48 hours. First, the April Canadian CPI print, expected to come in near 3%, will either confirm or challenge the rate hike trajectory the market has priced. Second, watch the Bank of Canada's next scheduled statement for any shift in the word consecutive. That single word is now the forward guidance signal the market is anchored to. If it disappears, the rate picture reverses. If it hardens, the Loonie and the banks have further to run.